Hello everyone, I'm very happy to be here. Financial Literacy, Part 2. Now in Part 1 we talked about the income statement, and that is archived, and I encourage anyone who did not attend last month's webinar to check out the archive. Today in Part 2 we're going to look at the balance sheet and the cash flow statement. If an income statement is like a movie clip, as we explained in our last financial webinar, a balance sheet is like a snapshot for a specific point in time. The analogy that we're going to use for the balance sheet is a house, is a home. If you purchase a $1 million home, you may borrow $800,000 from the bank and put $200,000 down as a down payment. I would like you to envision the entire balance sheet as the home as the asset. The liability part of the balance sheet is the liability, the loan, the mortgage amount, and the equity might be analogous to the down payment. Generally speaking, a balance sheet balances everything the company owns, the house, with how you paid for that house, the mortgage plus the down payment. Again, the balance sheet is about everything the company owns, O-W-N-S, versus everything the company owes, O-W-E-S. So what the company owns, those are the assets paid via equity shares. What it owes are the assets paid through borrowing. Now I'd like you to notice the order of each item on our balance sheet. It is in order of decreasing liquidity, meaning that the most liquid asset is cash. And then as we descend down on the balance sheet, we have decreasing liquidity. We go from cash to accounts receivable to inventory. All of these line items take a little bit longer to convert to cash. Conversely, the liabilities are listed in order of the shortest to longest term debts. The debts that must be paid back, let's say within 30 days, are going to be listed before and above any debts that are to be paid back in a year or more. And again, going back to our analogy, the balance sheet is the house and is composed of the mortgage, the liability, and the down payment, which is again analogous to shareholders' equity. Now what is the balance sheet balancing exactly? Again, to reiterate, the amount of assets balances against the amount of liabilities plus shareholders' equity. It really is that simple. Find on the internet, you will always see by definition that the total dollar amount of assets will equal to the total dollar amount of the liability plus the total dollar amount of the equity. Our balance sheet is segmented into three sections. Again, assets, liability, and shareholders' equity. And here, if you look at the right of the slide, we're looking at an actual balance sheet. And you can see from the items that we circled, the house is worth $132,395. Again, house, we mean the total value of the assets on the balance sheet. And you could see that the amount, $132,000 and change, is exactly made up of the liability, which is $71,620, plus the shareholders' equity, which we draw the analogy to a down payment of $6,775. So again, the full amount of the balance sheet, $132,395, equals liability, $71,620, plus the shareholders' equity, $60,775. Now, companies purchase assets to generate profits. It's that simple. Now, going back to our first financial webinar, profits equals all of the revenues minus total cost. It's that straightforward. And companies purchase assets specifically to earn profits. Now, again, there are two ways to purchase, just like there are two ways to finance your home. You use your own money, analogous to the down payment, or you borrow money, analogous to a company floating commercial paper, floating bonds, borrowing from a bank, which we say is analogous to the homeowner borrowing a mortgage from a bank. Now here are some illustrations of assets. Again, assets are items of value used to generate profits. They could include a fleet of trucks, a robotics factory, even office buildings. If you are a real estate company, an office building is a type of asset that directly drives revenue. If you are a railroad company instead, that same building is still an asset simply because you own it. Now, if you pay rent on that building, of course it is not an asset on the balance sheet, but an expense recorded on the income statement, which we discussed in the previous webinar. Now, an asset can support your business or directly drive revenue, but it is an asset regardless, as GAAP, the generally accepted accounting principles, does not distinguish an asset's purpose. Now, personally, I do make the distinction between an asset that logistically supports revenue and one that directly drives revenue by creating pro forma balance sheets. But that is beyond the scope of this talk, although you can investigate on your own. Now, the balance sheet, again, does not distinguish between an asset that drives versus supporting revenue. So let's give another example. You're a trucking company who owns trucks. Now, that is an asset used to drive revenue. If that same trucking company is now leasing trucks to rent them out in the retail market, those trucks are not an asset, but expenses recorded on the income statement. Now, if a real estate company owns trucks, obviously it's a real estate company. So those assets, trucks, are probably used for logistical support, but not to drive revenue, because a real estate company rents out office space, not trucks. So again, it's an asset simply by virtue of the company owning it, regardless of its purpose. Whether or not something is owned determined if it is an asset, not its role in driving versus supporting revenue. So to reiterate, if you own it, it is an asset on the balance sheet. If that same object, if you're leasing it, then it is an expense recorded on the income statement. Now, accounts are listed from top to bottom in order of liquidity. So let's go over that again, but with specific numbers. Now, liquidity is defined by the ease in which an account can convert to cash. So obviously, cash is already cash, and if you own a building, even though it is an asset, it might take some time to convert a large building into cash. Now, a current asset are assets that can convert to cash within a year or less, and a long-term asset is an asset that takes more than a year to convert into cash. So assets can be divided into short-term and long-term assets. Conversely, liabilities are segmented into current and long-term liabilities. A current liability is incurred and due within a year, and a long-term liability, well, those are obligations due more than a year out into the future. So here we're looking at another balance sheet, and the total assets of our balance sheet is $13,210. Now, in this example, we have segmented current liabilities and long-term liabilities, and we have total equity. So the total asset is $13,210, we see on the top, and if we add up $3,630, the current liability, plus $3,850, the long-term liability, plus our total equity recorded at $5,730, we will see that it balances out, hence the name, the balance sheet. Now, going back to our analogy, your house, your company. Think of the house as the mortgage plus the down payment. That would be the value of the house at the time of purchase. Conversely, assets equals liability plus shareholders' equity. The house at the time of purchase is valued at the mortgage plus the down payment. Now, if your house increases in value, your liability to the bank remains the same. The bank does not tell you that you owe more money because the value of your house went up. So, how does the value of your assets go up? Well, what you borrowed from the bank plus your down payment again, that equals the total value of your house. But after purchase, your house could increase or decrease in value. Regardless, your debt to the bank remains the same. So if assets equals liability plus shareholders' equity, that must mean that if your house goes up in value, not the liability, but your equity amount must increase. And conversely, if your house decreases in value, again, your liability to the bank remains fixed, so that means that the equity portion of the house must decrease. And this is what it might look like in an illustration. Here we have a house that is increasing in value, but whatever the homeowner owes to the bank remains the same. So equity becomes disproportionately greater in relationship to the liability simply because the equity of the house is increasing. And let's put some numbers here. There was a house purchased for $500,000. The homeowner borrowed $400,000 from the bank and put $100,000 as a down payment. As the house goes up in value, the $400,000 owed to the bank, right? We're not discussing interest. We're keeping the example very, very straightforward. The amount owed to the bank remains the same. So our house, as it goes up in value, it goes from $500,000, $600,000 to $1 million. You see from the numbers that we included in our illustration that while the red, the $400,000 remains the same, the green, the equity stake in the house goes up. And that is how a balance sheet works. Again, assets equals liability plus shareholders' equity. So how does shareholder equity increase if a company did not sell additional shares? Well, owner's equity includes both paid-in capital plus retained earnings. So the retained earnings portion of the balance sheet would increase. Now within the income statement and the balance sheet, which we discussed the income statement in the previous webinar, we can calculate ratios as leading indicators of financial health. Now ratios quantify multiple indicators in just one number. So imagine multiple numbers expressed as a single number, and this is great for pattern recognition, which is the real secret of a strategic mindset. Now, we always talk about leading versus lagging indicators, and to extend the analogy to a bowling example, those markings about 10 meters into the bowling lane, those are analogous to leading indicators, and knocking down the pins are analogous to the lagging indicator. So companies often talk about net income as the ultimate lagging indicator, and leading indicators could include some ratios. Here we're looking at a ratio called return on assets. The return on asset is simply calculated by taking net income from the income statement, which we covered last time, and the assets from the balance sheet. And we simply divide the two, and here we have our return on asset ratio, which is a wonderful leading indicator to the ultimate lagging indicator of how much net income will that company make. And here we've holistically broken down the equation so it includes more subcomponents. Net income equals total sales minus direct costs minus indirect costs minus all other costs, divided by assets, which again equals liability plus shareholders' equity. Now again, we have leading and lagging indicators, and another leading indicator might be the total asset turnover. Now this is about revenue, because this ratio is calculated by taking the revenue number, not net income, from the income statement and dividing it by the total asset amount on the balance sheet. This is another wonderful example of a leading indicator, something that marketing departments are specifically interested in. Now, let's talk about working capital to lead our discussion into cash flow statements. I want you to think of the inflow of cash analogous to an artery bringing in fresh blood and an outflow of cash as a vein. Working capital is calculated as current assets minus current liabilities, and both those items can be found on the balance sheet. Now think of working capital like replenishing a leaking bucket of water. Accounts receivable is money that the company is taking in. That's analogous to water being poured into the bucket, and accounts payable, money that a company owes to its vendors. That's money leaving the organization. Think of that as the water leaving from the holes in the bucket. If we have AR and AP both equal to 30 days, that would be analogous to the same amount of water being poured into the bucket being equal to the same amount of water leaving the bucket through the holes in our illustration. So the cash flow statement, let's talk about that. This is a cash flow statement, and you will immediately notice that the cash flow statement is segmented into three categories: operating activities, investment activities, and financing activities. The cash flow statement is analogous to the company's checkbook. This has to do specifically and literally with the amount of cash, dollars if we're in the United States, literally sitting in the corporate bank account. So operating activities, that would include cash or money generated from the actual business operations. Investment activities would be money received or spent from investing activities, and financing activities would be money received or paid out related to how a firm finances its activities. So let's look at a cash flow statement. If you have positive net income, you have cash coming in. If you're selling assets, which is usually not a good sign, but if a company is selling its factory, selling its patents, well then we have money entering the company under the investment category. And if money is coming in through financing, that means the company either sold stock or borrowed money from a bank or sold bonds. Conversely, if money is leaving the organization under operations, we're talking about a negative net income. Investment, it's a good sign. If cash is leaving the organization under the investment category, that means the company is spending its cash on assets. And again, factories, trucks, companies purchase assets to generate profits. So money leaving the investment category, the cash flow statement, is a wonderful leading indicator to a company trying to be poised to making even more net income. And if money is leaving the organization in the cash flow statement under the financing category, it could be that the company is paying back the bank, paying back bondholders, or possibly even executing a stock buyback program and purchasing back its own stock. Again, this is another illustration. Here you can look at it on your own. We're simply looking at a cash flow statement, but instead of hypothetically, we've put specific numbers. Our non sequitur of the day: you don't attract what you want, you attract who you are. I hope you join me next month on July 13th. Don't just update your resume, but revamp it. If you'd like to check out more, please check out hravantgarde.com. That's hravg.com. I hope to see you at our next webinar. Thank you.
Vincent, the first question is, if I'm thinking of joining a new company, what would be the best way to look at it in terms of the financials?
Sure, good question. Well, there are a couple of different things you want to look at. Now, again, if it's a public company, you could find their financials on the internet as public documents. If you're thinking of joining a company, of course we want to look at net income. Is the company making money? But there are a couple of leading indicators we could look at. You may want to look at R&D dollars, research and development dollars, as a percentage of revenue, because if that amount is increasing, that means that the company is poised for growth. Now, it's not a guarantee that the company will successfully execute that growth, but it is a direct indication that the company is in growing mode, not in status quo mode and not in retrenchment mode. Another indicator that we touched upon in this webinar is looking at the cash flow statement. If you see that cash is pouring in under the investment category, that is because a company is selling office assets. Companies do that when it is in retrenchment mode. So that would be not a good sign. So one of the things that I look at is I want to see cash leaving the cash flow statement under the investment category, because that means that the company is purchasing assets, and again, assets are acquired by companies to generate profit. So that's a really great long-term indicator. You want to look at cash leaving under the investment category. And in conclusion, we can also look at research and development dollars as a percentage of revenue. Is that amount growing or is it shrinking? And a more short-term indicator is, did the company make money just from net income? So those three indicators occupy different views of time, from a shorter view of time to a longer-term view of time.
Okay, and here's another question. Can you tell me how I could use a pro forma income statement and balance sheet?
Well, pro forma means hypothetical, right? Pro forma income statements and balance sheets are not filed under the generally accepted accounting principles. So sometimes when a company is considering a merger and acquisition, they may create a hypothetical balance sheet to say, what would a balance sheet look like post-merger? Now, the merger has not taken place, so that's why they're putting together a hypothetical or a pro forma balance sheet. Many companies say that people are our most important asset. Now, the irony is that people are recorded as an expense on the income statement and not an asset on the balance sheet. So companies that do consider people their most important asset, they often develop a pro forma balance sheet where there are many formulas, and it's a little bit art and a little bit science, but there are many formulas where companies could benchmark and put a dollar amount on the value of their human capital, and then they could put that in a pro forma balance sheet or a hypothetical balance sheet. Now, the way this is used is that once you normalize the data, you could compare the value of your human capital against your own company through different moments in time. You're benchmarking it against historical amounts of human capital, and this is a way to really gauge, are you developing your people, are you incentivizing your people, are you treating your people well, that they feel that they're in an environment where they can be productive. And also for a pro forma income statement, this might be that you are putting together a new project and you would like to forecast what would be the impact of that project on net income. So if you were to hypothetically freeze every activity of that company except your project, what might be its weighted impact on net income? Because ultimately many things cause net income to go up or down. So this example of a pro forma income statement would be trying to theoretically isolate what would be the impact of this one project on net income if every other activity of the company were to remain in a static mode, which again is not possible, and that is why it is called a hypothetical or pro forma income statement.
Vincent, do you have any other final thoughts for today? Anything about your webinar, any other webinars that you have coming up?
Well, I will say business literacy really is a type of literacy, and it's so important. Any employee that does not speak the language of business, which is finance, they have to wait until a recruiter or an employer tells them what their value is to the organization. But to any individual that understands basic financial documents, they're able to ascertain their own value to the organization. And of course, they go into negotiations. It could be performance appraisals or negotiating for a raise or promotion. They go in with that much more knowledge. So I do think financial literacy is not that hard if it's taught the right way, and it is such an essential component to people's career aspirations. Upcoming webinar would be an entirely new approach on how to revamp a resume, taking into account specifically how recruiters process resume information. So I hope you join me for that. And then we also have webinars on how to deploy ethics in your organization. So the scope of all of our webinars is I want our audience to be able to leave with at least one piece of operational advice, hopefully more, that they could immediately begin using the next day to improve the quality of their professional life.